We will study main factors in production and financing. Over long term, a business has to achieve positive return to survive and prosper. What factors determine the return of a business? In accounting and finance courses, we have learned how fixed cost, variable cost, size of the output, operating leverage, financial leverage, duration of projects, interest rates, and level of uncertainty impact returns. We want to consider these factors together and more systematically. We put these main factors together. The first, the most important one, is the fixed cost, then variable cost, duration of production, discount rate, uncertainty, revenue, market size or production capacity, and maybe some other factors. Fixed cost. There is a necessity for fixed cost. The ability to obtain resources and generate revenue require initial fixed investment. Examples. For example, we have needed to have a bank branch to open businesses, or we need an ATM system to conduct transactions. Nowadays, we need to establish online system to do businesses. But anyway, we need some initial fixed costs to start a business. The purpose of fixed cost is to reduce variable cost. Bank branches make it easier for clients to do businesses. ATM machines reduce cost of manpower. More reputable banks can charge higher fees. Higher down payment reduce monthly payment. So the question is, how much we should invest in fixed cost? We may have some questions. There are many examples of a low fixed cost investment with high returns. Writers require low level fixed cost investment compared with accountants. However, J.K. Rowling gets a lot of income from writing Harry Potter books. However, an average author does not earn a high income, although a small number of authors earn high incomes from blockbusters. The typical writer lives in his parents' basement instead of mansions. There are other cases of zero fixed cost investment with high profit. One more example is the zero down payment mortgage, adjustable rate mortgage. This type mortgage is very popular in US before 2008 financial crisis. So what happened eventually? We got the biggest financial crisis since the Great Depression. A low fixed cost investment is unlikely to yield high return on average. However, a low fixed cost investment, being flexible, can often take advantage of new opportunities quicker than high fixed cost investment. There are other important factors in business. One is financial leverage. A business with high financial leverage is heavily financed with debt. Debt is also called Fixed income securities. Fixed income for investors is fixed cost for issuers. So financial leverage is part of the fixed cost for businesses. Another factor is operational leverage. Higher operational leverage means lower variable cost, which means higher fixed cost. Higher operational leverage is higher fixed cost. By grouping many separated factors into a more systematic structure, we can gain a broader and a deeper understanding of businesses. Now let's do a simple example about the relation between fixed cost, variable cost, and the market size. Suppose you plan to open a general store or supermarket. There are two potential sites. The site close to highway and with ample parking space, with fixed cost of $200,000 a year and has a variable cost of 50%. The site in a small community with fixed cost of $25,000 a year and has a marginal cost of 80%. What is the potential profit of each site if annual revenue is $200,000 or $2 million? What site would you choose under each circumstances? Explain why in an age of no cars, general stores are more popular, and in an age with cars, supermarkets are more popular. With annual revenue of $200,000, profit of a low fixed cost project is $200,000 times 1 minus 80% minus 25,000, which is equal to 15,000. Profit of a high fixed cost project is 200,000 times 1 minus 50% minus 200,000, which is negative 100,000. With annual revenue of 2 million, profit of low fixed cost project is 2 million times 1 minus 80% minus 25,000 is equal to 375,000. Project of high fixed cost project is 2 million times 1 minus 50% minus 200,000 is equal to 800,000. Now we go over more realistic scenarios with competition. To drive out general stores, supermarkets lower the unit price from 1 to 0.8. Then profit of low fixed cost project is 2 million times 0.8 minus 0.8 minus 25,000, which is equal to negative 25,000. So this is a loss. Profit of high fixed cost project is 2 million times 0.8 minus 0.5 minus 200,000, which is equal to 400,000. In a time with no cars, market size is small. General stores with low fixed cost are profitable. Supermarkets with high fixed cost can't survive. In a time with cars, market size is large. Supermarkets are more profitable. With high profit margin, supermarkets can lower prices to drive general stores out of businesses. The upside of high fixed cost systems. They are low variable costs. They are capable of producing high value products. They have large production capacity. They will earn high profit when output level is high. Downside of high fixed cost systems. It requires large initial investment. It takes a long time to break even. It requires large market size. It is vulnerable to downside risk. It needs large amount of resource support. The social structures and social policies are complex in high fixed cost systems. The relation between high fixed cost systems and financing. Financing is often required for high fixed cost systems. In earlier days, financing is often closely associated with governments. Governments require large amounts of spending, especially during war times. The development of financial institutions and financial markets are closely related to economic growth. When market size grows, high fixed cost businesses are more profitable and competitive. Duration of production. It takes time to recoup the initial investment. A project has to last for some time. However, with a longer duration, maintenance cost increases. How to choose duration of production. Example: taxi companies retire their cars long before the cars can break down easily on the road. Benefit and cost of long duration. Benefit of long duration. Initial investment can be utilized over a long time. Cost can be spread over. Long-term mortgage reduces monthly payment. Cost of long duration increases the maintenance cost and hence the variable cost in production. Difficult to adjust in a changing environment. Long-term mortgages suffer heavy losses in the 2007-2008 financial crisis. Societies with a long lifespan incur higher medical and senior care costs. Societies with a long lifespan get hit harder in pandemics. The necessity of the fixed cost investment and finiteness of lifespan determine the universality of resource transfer between generations. But process of resource transfer is often the source of many conflicts between generations and within the members of the same generation. Ownership or leadership transition often involves high level of uncertainty. An example is Geico, government employees insurance company. When the founder of Geico died, his son took over. The new heir expanded the insurance business aggressively. Many reckless drivers get insured. Insurance claims skyrocketed. Geico almost went bankrupt. Yale killed himself. Buffett bought the company at rock bottom price. Parental-offspring conflict. Many parents feel that children demand too much from parents. Children feel they don't get enough care and attention. When technology is available, many people delay their reproduction so they can delay the transfer of resources to next generation. As a result, the age of giving birth has been increasing over time. In societies where senior incomes are guaranteed, many people choose not to have kids or have few kids. Fertility drops below replacement rate. Society declines. Conflicts of different generations of products. Cell phone. From analog to digital. Motorola was the dominant player in the analog market. When digital cell phones were developed, people inside Motorola worried that digital system could erode the market share of the analog phones, which will render their expertise in analog systems obsolete. So they were reluctant to act quickly. As a result, Nokia became the leader in the digital phone market. From regular phone to smartphone, BlackBerry was the leader. From physical keypad to touchscreen, Apple replaced BlackBerry. Will Android make iPhones marginal in the future? In each generation, new companies replaced old companies as the dominant players. The difficulty of transition gives new companies and young people opportunities. Present value of a series of payments. Next, we will review the formula for the present value of a series of payments. This will help us in decision-making with periodic cash flows. Here is the formula for the present value of series of payments. There are two situations. One is that the growth rate is 0. The other is the growth rate is some fixed number. So there are two formulas. So these two formulas are very useful in calculations. The best way is to derive it, but anyway, we should remember that. Okay. Now we study the relation between fixed cost and project duration. Suppose a company has a choice to select one of the two projects. The first project requires an initial spending of 10 million. The project will generate 3 million profit each year. The second project requires an initial spending of 20 million. The project will generate 5 million profit every year. The discount rate is 5% per year. If two projects last for 5 years, which project you will choose? If two projects last for 10 years, which one you will choose? The criterion of selection is net present value of a project. Answers. If the projects last for 5 years, the NPV of the first project is 2.99. NPV of the second project is 1.65. So we will choose the first project. If the projects last for 10 years, NPV of the first project is $13.17 million. NPV of the second project is $18.71 million. We will choose the second project. In general, with short duration, low fixed cost project is preferred. With the long duration, high fixed cost project is preferred. In general, higher fixed cost projects last longer. Elephants live longer than mice, which live longer than bacteria. Large companies, on average, last longer than small companies. Professionals who take a lot of effort to get qualifications switch professions less often than non-professionals. Women invest more in childbirth than men, so women usually prefer longer-term relations than men. Discounting. Cash flows at different points of time need to be measured with discounting. The determination of discount rates is the most difficult problem in finance. We will spend a lot of time on this problem in this course. Fixed cost and discount rate. A company has a choice to select one of the two projects. The first one requires an initial spending of $10 million. The project will generate $2 million profit each year. The second project requires an initial spending of $20 million. The project will generate $3.5 million each year. Both projects last for 10 years. If the discount rate is 5% per year, which project you will choose? If discount rate is 12% per year, which one you will choose? The criterion of selection is NPV of a project. Answers. If the discount rate is 5% per year, NPV of the first project is $5.44 million. NPV of the second project is $7.02 million. We will choose the second project. If the discount rate is 12% per year, NPV of the first project is $1.3 million. NPV of the second project is negative $0.22 million. We will choose the first project. Lower discount rate stimulates high fixed cost investment. Discount rate not only impacts the amount of economic activities, but also impacts the structure of economic systems. Discount rate and growth. The company has a choice to select one of the two projects. The first one requires an initial spending of $10 million. For the next 10 years, the project will generate $3 million each year. The second project requires an initial spending of $20 million. The project will generate $3 million profit the first year, the profit from the project will increase 10% from each previous year. Both projects will last 10 years. The criterion of selection is NPV of a project. If the discount rate is 12%, which project you will choose? If the discount rate is 3%, which project you will choose? What kind of monetary policy will encourage economic growth? When the discount rate is 12%, NPV of the first project is $6.95 million. NPV from the second project is $3.78 million. So we will choose the first project. When the discount rate is 3%, NPV from the first project is $15.59 million. NPV from the second project is $18.08 million. We will choose the second project. Discount rate and uncertainty. Someone proposed to you, claim that the profit from a project will increase 10% per year for the next 100 years. You might think his projection should be heavily discounted. That's right. Uncertainty is often reflected in discount rate. But why central banks seem to be able to adjust discount rate freely? Do they have to consider the relation between uncertainty and discount rate? A rising tide lifts all boats. In a rising economy, even optimistic projections are often realized. The last several hundred years are a rising tide. In such an environment, long-term uncertainty is small. High fixed cost investment, low discount rate policies are generally winners. Indeed, high fixed cost investments and the low discount rate policies are visionary. However, in many wealthy countries, fertility rates have dropped below the replacement rate for several decades. This shows that the biological return of our societies have already become negative. The same policies will have negative impacts to the sustainability of our societies. Concluding remarks. The above examples illustrate the relations among major factors in economic activities. Later we will study some more examples and explore broader issues.